And we're going to move on to the next segment. We've only got 2 segments this week. 2 topics we're going to talk about are small cap stocks at an inflection point. Jerry, are they?
I think so. And I would, let's not even use the term small cap, because a lot of people, that we're speaking our language. That means small capitalization. What's capitalization? It's the value of a company in the market, what the market values it at based on the number of shares times the price of the stock per share. So in public stock trading jargon, we call it a smaller company. And nowadays, with the values of companies having grown over the decades, what used to be a small cap stock is now a much bigger number. So I still like to kind of use the $1 billion market value as below that is small cap, above that is mid cap, and you get above 10 billion, it's large cap. I'm dating myself because there are those that say, well, you're small cap if you're under 5 billion, and you're mid cap if you're 5 to 20 billion, and it's 20 billion and up that are large cap, and then you have mega caps that are like the Apples and Amazons that are in the trillions. So there's certainly some talk about inflation and market capitalizations, but so let's say smaller companies, okay, that have not really, I still don't know that enough people realize or know that the market movement, market meaning market averages, move over the last couple of years has been primarily driven by about 10 companies. If you look at the Standard & Poor's 500 stock index, or the Magnificent Seven, but let's say 10-ish companies make up a significant portion of the return of the market. So it hasn't been very broad-based. Now, recently, it's been broadening out. But in a period of time where some of those mega caps did well, many smaller companies did really poorly, and particularly those that are focused on growing and innovating. I think there is an inflection, partly driven by, in the short run, interest rates finally peaking and inflation finally peaking, which shouldn't necessarily be the focus, but it is. So in the short run, that does matter. And since those peaked, the short run looks like it's going to, be favorable for smaller companies. But the large. So yes, I think that's causing an inflection. But there may be something more at work here, and that may be after a pretty extended period of time. And I would say most of the 21st century, there has been, it has been an environment that has been less than favorable for smaller companies. And that's primarily because the number one reason, in my opinion, and there are others that would agree with me, I think, plenty that might disagree or do disagree, but the number one reason is the level of government spending has been off the charts and has distorted capital formation and even further exacerbated by bring back the Federal Reserve again, inordinately low interest rate policy for most of the 21st century until recently. And the combination of those two things, and then adding the other very significant component, which has been significant government overreach with respect to regulation. Going back to the dot-com era, late 90s dot-com era, reaction to 9/11, reaction to the 08-09 mortgage crisis. We've been in this kind of perpetual crisis, jumping from one crisis to the other, and the solution has always come from government, more regulation, more control, and all of that has combined to make it a much more difficult operating environment and capital raising environment for smaller companies. Remarkable that many of them still have been able to do well in that period of time, but not as well as they should have, and there should be more of them. Bring back again the 8,000 to 4,000 problem. And I think that's the inflection that might be changing. We might be starting to sense that trend of big government. You remember, as Ronald Reagan, I believe, said, the era of big government is over. Or maybe it was Bill Clinton. Did Bill Clinton say that, or did Ronald Reagan say that? Ronald Reagan.
Whoever said it was wrong. But
Yeah, I think Clinton might have said that actually, as he was being the moderate play, taking the moderate play post George Bush 1. Nonetheless, you're right. That proved at least it proved short lived. Remember the peace dividend? Um, you're not too young to remember that, I don't think. I think there could be an interruption, at least an interruption in the trend towards bigger, more intrusive government, more spending government, more aggressive and loose Fed policy. And if that should be the case, then there's really kind of a hang on to the hats, bar the door. We could see a significant kind of like early 80s to late 90s type of explosion, which turned out to be an interruption in the trend, right? We thought it was a new way of doing things and would last, and to some extent it has. I don't think we can discount take the marginal tax rate at one point, which we all know nobody paid, but at one point got up to like 90%. And then ended up at the highest rate being 28% in the Reagan years. What are we at now, right? 39%, I think, is the highest. And most people aren't in that probably either. So, we're still relatively low. So that revolution did not completely go away. But certainly the spending post World War II, and I suppose you could say, post-depression spending craziness, has certainly continued. So that could there be a change? Could there be another change in trend coming? I think there could be, because I think people are starting to get a sense that this hasn't worked that well, and especially for smaller business. Smaller businesses don't benefit. Big businesses do when there's more government control, because they have the money to be able to comply with the regulations. They have the lobbyists. They have all those things that, they love it. And I want to catch myself sometimes when I'm making these accusations and criticisms of the large companies. It's not that I'm against large companies. More power to them, especially, but most importantly, I want them to become large companies in an environment where smaller companies can compete just as easily. But if you're big enough and powerful enough in the marketplace, not how you work in Washington or Brussels or wherever, that shouldn't be what makes you successful and makes you larger in the market.
When competition leads to anti-competition, that's the problem. So
theoretically. Well, that's what's happened.
That's what's happened. Competition is great, and then when companies that rise to the top on the basis of their own merits, suddenly squash competition through cronyism and lobbying, then that's a problem.
Yeah, well, and I would argue that if they get to that point and they're completely on their own with no government support, they're going to get, almost by definition, they're going to see innovation come from below, and unless they're really, really, really good, and there are some companies over the years that have been good at that, over decades, have been good at that, and don't necessarily point to government help to do it. But more and more today, that's what's happening, and that's the problem. I mean, I would argue that the antitrust. So for example, remember the big antitrust suit against Microsoft. When that finally was solved, Microsoft on its own, by virtue of its power in the marketplace, was already starting to lose that luster and was getting enough competition, from other operating systems, not the least of which is the Apple operating system. And so by the time the government got around to attacking them for being antitrust, or for being a monopoly, they were already waning on that. And so I think that when allowed to operate normally, without, with a level playing field, if you will, it's tough for anybody to stay on top in a truly free enterprise system. If they do, more power to them, and they should be allowed to do so. And I don't mind investing in those companies. But I think we have now an environment where these larger companies have a real advantage that if that should change, then that's going to benefit smaller companies a lot. And smaller companies still generally are the ones that innovate even in spite. Get back to that, we get by in spite. But it should be more pervasive. Larger companies have to be a lot more worried about competition coming from below, disruption coming from below. And right now they don't have to worry a whole lot. And unfortunately, I mean, as investors, it's a bittersweet end game when your company as a smaller company is acquired by a larger company. More and more that's just, companies acquire these smaller companies just to get rid of the problem. There was a time where that was less possible. It could still happen. And if it does, again, in a level playing field in a free enterprise system, if that happens, so be it. If synergies can be reached and it allows that company to then compete even more, so be it. But that there's not enough. What we're seeing now is it's happening because the smaller companies don't tend to have a whole lot of choices.
It does beat the alternative where they're just being litigated out of existence. I mean, acquired is better than that, but yeah, it's not.
So anyway, yeah, I think there is an inflection happening. It may be slow in ultimately culminating, but we'll see. I think a policy correction is coming, and it may be sustainable for a while because I think most folks are starting to look at this kind of this policy environment, not the least of which the cultural environment, but let's just stick to policy. And it really is problematic. It's problematic. When you look at the British Labour Party, when was the last time you could say that the British Labour Party was right of the American Democratic Party? When the British Labour Party is talking about being more pro business and keeping tax rates level or even lower, that there's something going on out there, at least in the broader world. Might Europe finally have figured out that their massive spending social state is not working after decades of underperformance versus the U.S.? Unfortunately, the U.S. trying to adopt more of what they had been doing, it's now tilted to the other direction, and hopefully we won't have to go through a long time of drought in economic growth, like Europe has, to recognize the error of those ways. They seem to be recognizing it.
It's a real world case of the Harlem Globetrotters stealing the Washington Generals playbook and trying to run it. So,
yeah.
It's also worth noting we don't rely on reversion to mean, but the S&P is at all-time highs. If my math is correct, it's really not math. It's looking at a chart. The small cap indices are not. So something that isn't going to be at the front and center of your investing decisions, but lurking in the background is simply the fact that the S&P has more room to run for a variety of reasons.
And just to wrap this up, there is a downside right now, and unfortunately, and I think it's due to the massive amount of algorithmic trading that's going on out there. The majority of trades happen from a computer, not a human. The volatility in these smaller names is off the charts. So you really have to be more than ever able to look the other way, be in it for the business, not the stock trading. Because if you're in it for the stock trading, it's frankly just silly. It's absolutely silly and insane the way some of these changes in prices happen. Which, another podcast, we've talked about it before in previous podcasts, another podcast we could spend on just purely the liquidity issues in the market. I mean, all of these, innovations, quote unquote, financial innovations that have swamped the market that were supposed to give us more liquidity have done absolutely the opposite. And if somebody wants to argue with me on that, fine, make the argument. 38 years of watching stock trading, Do not try and convince me that we have a more liquid market today than we did in the past. It at least is not more liquid. It's because these wild swings wouldn't be happening as frequently as they do, literally second by second. And I don't think that's healthy. We can look through it because in our strategy, we're looking for long-term company performance. But it's just annoying and frustrating to have to watch this happen on a day-to-day basis and literally second-to-second basis. That's a downside. Successful investors will be able to look past that. Because at the end of the day, the business's fundamentals will ultimately win out one way or another.